All right. Good morning, everyone. Thank you very much for coming in or logging in for this financial presentation. I did do some previous presentations earlier. They were kind of a coffee with Carter where I did some Q&A sessions. And out of those sessions, there were certainly some questions and some demands for, hey, can we get some more information around the organization regarding, what kind of its structure and regarding the financials of the organization. I said, absolutely, sure. I have that information and I do those presentations. So basically by popular demand, that's what we have here today. So I'm going to go through the slides, and if you think of any particular questions, right now I'm not in the room with the where everybody else is attending at the moment. But just remember, just write your questions down and there will be time at the end to go back and address any questions that you may have. So with that, I'm going to go ahead and get started. If I can advance the slide here, just a moment. So just a little bit of the agenda for today is we're going to talk about, and a lot of this is going to be high level because I only really have an hour to kind of get through this information, but we're going to talk about the organization and some of the affiliated organizations and how those are structured. We're going to go over the results of the prior year. When I say the results of the prior year, Royal Oaks has a fiscal year end at the end of February. So February 28th or 29th of every year, we'll close out our year. During March, we'll have an audit in April and we'll release those results in May. So this is for the last year that closed out, which would be February 29th, 2020. I'll go into a little bit of detail about the expansion from the aspect of, how that financing is coming and what the proposed estimated construction schedule is. We'll also talk a little bit about the foundation, which is one of the affiliates of the organization. And then, like I said, at the end, we'll open it up to questions. So first thing, let's talk about the various organizations. So the first one up is obviously the main organization. So it's the People of Faith Incorporated. This is the one that's Royal Oaks. We are doing business as Royal Oaks Life Care Community. So it is People of Faith Incorporated is the actual corporate name, but it does business as Royal Oaks Life Care Community. So when you're, for all of you that are depositors at Inspirata Point, it's Inspirata Point at Royal Oaks, which is part of People of Faith Incorporated. The other affiliate that we have is the People of Faith Foundation Incorporated. So this is a completely separate entity. And this is the philanthropic entity. This is the one that we really want to kind of do the particular fundraising and any special programs as a result of that fundraising. We kind of separate that into the foundation. And lastly, we have a limited liability company, Cactus Sky LLC. Now, this is a limited liability company, and really its sole purpose is to just kind of take a look around for any potential future development. And for the most part, that means just kind of looking around at land. With our Royal Oaks campuses, there are a lot of parcels, little parcels that are around us, and we always keep an eye out for if those parcels are ever available for sale. We certainly would want to probably take advantage of that. So as far as each organization, we talked about the People of Faith Incorporated, and that is a 501c3 organization. So it's organized as a nonprofit in Arizona. So it's a 501c3 charity organization specifically related to provide life care services. And it is the life care operations. So the Royal Oaks campus, all the services, all the amenities, the Inspirata Point campus, the services, the amenities, that is all under the umbrella of Royal Oaks, People of Faith Inc., Royal Oaks Life Care. And all the assisted living is licensed under People of Faith Incorporated. And it is governed by a board of trustees. People of Faith Foundation is also a 501c3 charitable organization. This one, though, is specifically organized to be a supporting organization for People of Faith Incorporated, which is Royal Oaks. So the only thing the foundation can do is activities that actually support People of Faith Incorporated. So it can certainly raise money through charitable contributions that are subject to tax deductibility. However, the programs that it does has to benefit the People of Faith Incorporated. It is governed by a separate board of directors. So you have a board of trustees that oversees People of Faith Inc., and then you have the board of directors that are the foundation. They are two separate boards. Can there be an overlap between the boards? Yes, but there currently is not. In the beginning, when these organizations were very first founded, there was some overlap, but now there doesn't need to be, and there generally is not. The only thing with the board of directors for the foundation is the board of trustees does have to approve any nomination to the board of directors. Cactus Sky LLC, it is a limited liability company. It only has one member, which is People of Faith Incorporated. So there's no other entities involved in Cactus Sky. It is simply formed on paper with People of Faith Incorporated as its only member inside of that LLC. Like I said, it's basically there to search for land for the future. It is funded by transfers from Royal Oaks. So in that particular sense, there is an evaluation that's kind of done close to the end of every fiscal year to see if there's any funds that can be transferred over to Cactus Sky. And then Cactus Sky just kind of holds that funds. So if it ever needs to move, whether to investigate or do some research or a survey or put in an offer, it has the resources to do that. So we've got three different entities here. And for those of you that have maybe gone through our audited financial statements, you'll notice that when we do a financial presentation of these entities, they're all consolidated into one financial presentation. And so you'll see that all the assets and the liabilities and the revenues of all three of these entities will actually be consolidated. However, in the back of the report, there is supplemental information that will break out the activity for each one of those entities. So People of Faith will have its own balance sheet and revenues and expenses, and the foundation will as well, and Cactus Sky will as well. So there is sufficient information to figure out what entity is having what activity. It's just presented in the back. The reason it's consolidated is for accounting rule purposes about how they're, just all related organizations or controlled organizations. We don't need to go into those technicalities here, but if for those of you that review the financials, I just wanted to make that clarification. The one thing I also want to stress is the People of Faith Incorporated, which is doing business as Royal Oaks Life Care, is the only obligated entity in relation to the bonds. So there are bonds outstanding from a previous bond issue. There will be bonds that will be issued upcoming shortly for the construction of Inspirada Point. And the only obligated entity is People of Faith Incorporated, doing business as Royal Oaks. So the foundation has no responsibility or obligation to pay the debt, nor does Cactus Sky. With that, we're going to take a look into what happened over the last fiscal year. So this would be from March 1, 2019 through February 29, 2020. So the first thing that we'll look at is we're going to look at the balance sheet, and the information that's going to be presented here is just for Royal Oaks. So this is just for the People of Faith Incorporated. And some of this information is going to be summarized simply because it's just easier to kind of group things together rather than go over each individual line on some of these documents here. So the first thing is on our balance sheet, we have unrestricted cash and investments, and those totaled about $60 million. So certainly we have cash that we use for everyday operations, and for items that can be invested more in the long-term nature, they're moved over to the operating reserve, and that's where most of that $60 million is going to sit. But that operating reserve is available for operations. We can pull from it at any time. The portfolio of the organization, the operating reserve, it is an aggressive portfolio. It's probably about 80% equities and about 17% fixed income, with maybe 2 or 3% that's held in cash for liquidity purposes. Property and equipment. This is basically the campus and all the equipment. This is all the land. This is all the buildings. This is all the furniture and equipment that necessary to provide the services. And that totaled $58.8 million. Now you'll notice it says property and equipment net. That means it's net of accumulated depreciation. And for those of you that may not be familiar with it, when you purchase an asset, you basically capitalize that on your balance sheet, and then you recognize a portion of that expense over time. So this $58.8 million is the amount of fixed assets that have yet to be recognized as expense. All the other assets, so you can clearly see that the two biggest portions, 60 million, almost 60 million a piece, is the cash and investments of the property and equipment. All the other assets we have on our balance sheet, whether it be inventory, prepaids, receivables, they total up about 15.2 million. And actually, out of that 15.2 million, 9 million of that is actually an intercompany receivable that's due from Cactus Sky. So Cactus Sky had purchased some land on which that Inspirada Point will be developed, and it's going to transfer that land over to Royal Oaks. And when it does, that money is going to move on the books from other assets to property and equipment. So even out of that 15 million, 9 million is going to be land that's going to be coming back, or a portion thereof will be coming back to Royal Oaks. So the remaining, 6 million is all these other assets. On the other side of the balance sheet are our liabilities. Now, we've got kind of the same thing. We've got two big liabilities, and everything else just kind of falls into the other category. So our current outstanding bonds is about 35.3 million. So there was some bonds that were issued back in, I want to say 2002 and 2010, and then they were and then even in 2014, and then they were all refinanced into one bond in 2016. And the balance of that bond issue is 35.3 million. That's what was outstanding at February 29th, 2020. The other biggest portions are, we have our deferred entrance fees. So when you're paying an entrance fee, the non-refundable portion of the entrance fee, so you have the type A non-refundable, you have the 50% refundable, and you have the 90% refundable. For any portion of that entrance fee that is non-refundable, it goes onto our balance sheet as a liability, and it gets similar to fixed assets, it gets amortized over time. But instead of recognizing this as an expense, it's recognized as a revenue for us. And the reason for that is because when you're paying that entrance fee, you are doing a little bit of a prepayment for certain services. And as we provide services, we're able to recognize that revenue over time. That's the general principle behind deferring those entrance fees and recognizing them over time. All the other liabilities, which are mostly operational liabilities, accounts payable, accrued payroll, accrued vacation, other various accrued expenses, interest payable on the bonds, other types of customer deposits, they're all rolled into this other liability, that's 6 million. So you can see our balance sheet is certainly, large as far as total assets and total liabilities, but even within those categories of assets and liabilities, they're really in, a couple of big items, and then we kind of group everything else together. So let's go ahead and take a look at those totals. So on our balance sheet, all those assets totaled about $134 million. And then all of our liabilities added together was just shy of $89 million, okay? So the difference between the two is our net assets. So that is our equity. So for those of you that may be in the for-profit world, it may have been called owner's equity, but in the nonprofit world, there is no owner. So in that particular instance, it's just called net assets. Total assets minus total liabilities is net assets, but it's the same thing. That's the equity that's inside the corporation. Okay. So that 45 million is a positive 45 million. Okay. Now we're going to switch a little bit because the balance sheet was kind of a snapshot in time. That's what the balances were as of a certain date, February 29th. Now we're going to take a look at what is the change that happened during the year? What is the activity? And that's where the revenues and expenses are. Now, this is a little bit more detailed than probably what you would see in the financial statements, and because I just wanted to highlight a few things. Generally speaking, if you look at the finance, this is also organized a little bit differently than in the financial statements. It comes up to the same number, but it's organized a little bit differently because I wanted to kind of separate out what are monies that come from the residents versus monies that come from other sources than the residents. And so this operating revenue section here, this is all money that's generated mostly from residents. So we've got monthly service fees of about 14 million, and those are monthly service fees that are generated from people that are living in the independent living. Then in our healthcare services, we have monthly service fees from those that are generated in our assisted living environment. Now, for those of you on the type A plan, which all of you should be on the type A plan, remember, your monthly service fee doesn't change because you need a higher level of care, but we just put it in a different bucket from the aspect of where we record the revenue on our financial statement. So resident services is mostly people in independent living. Healthcare services are those that are using the assisted living services. And so you can see those two monthly services together are about $18.1 million, and the total is 21.7. So you can see a vast majority are monthly service fees from residents. Now, we do have some what we call community residents. These are direct admits to our assisted living from the outside community. So they didn't buy a life care contract, but we do have excess capacity in our assisted living area. So we will go ahead and provide services to them as long as we have that excess capacity. But they're going to pay that market rate. And that market monthly rate, depending on the level of service, could be $5,700 a month all the way up to $7,800 a month, depending on what level of services they need. So all those community residents, that added up to about another $1.4 million of revenue for us, which is good, because whenever we have additional capacity and we can use it to generate revenue, that's what we're going to do. We do have meal per diem. So inside the assisted living, we do provide additional meals. So when you're in independent living, as part of your contract, you're going to get 1 meal per day included with your monthly service fee. When you go to a higher level of living, when assisted living, we are required by law to either provide you 2 meals a day or 3 meals a day, again, depending on the level of service that you need. And so we do have to charge you for those extra meals. That added up to about $800,000. Then we have various supplies. For the most part, this is really just a pass through. Whenever somebody needs various medical supplies, we'll pull it from our inventory and we'll provide it, and we'll just charge it. And that added up to about $57,000. All the other revenues combined, it could be miscellaneous revenue. We do have some rental income from some providers that rent a very small space with us, but other ancillary things like food sales, catering sales, beauty salon, just those little ancillary services, all of those kind of grouped together add up to about 1.2 million. So you can kind of see the breakdown of that operating, the vast majority coming from monthly service fees. So let's take a look at the breakdown of expenses. And these are, again, kind of separating out expenses that are for services directly provided to residents versus any other type of expenses. So clearly you can see that the look at the top two, you've got $12.4 million in salaries and wages, and then $2.8 million in employee benefits and taxes. So out of that 22.6 million, more than half is in the labor force of the people that are going to be providing services to you. And that's pretty normal from our industry. It's a people industry. We're providing services to people by people. Medical supplies and drugs, $84,000. This is the various supplies that we need, from PPE to supplies that we may have to pass through to residents in assisted living. Like I said, actually not really big as far as the expenses right now at $84,000, which is good because, like I said, more of ours is service driven. Professional and contracted services, these are various things that we hire out, various consulting, accounting, attorney. There is some medical professional stuff in there, but it's mostly other types of professional. Food, 1.9 million. This is actually the raw food, the raw food product that comes in the door, prior to its preparation. So $2 million in food for this campus. It's a pretty sizable number. All the utilities that are included in your monthly service fee, like the electricity, the water, the sewer, the gas, all of that stuff, obviously we pick up the cost of that, and that's fine. $1.2 million for all the utilities combined. And then others is about 3.3. Now, what's included with these others? Well, these are all kinds of repairs, maintenance, supplies, other types of various things that, quite frankly, don't fit into any of the other categories, and on their own really wouldn't even add up to almost anything in the other category, with maybe the exception of medical supplies and drugs. And we just generally break that out because we're in the assisted living industry for a portion of our business. So all told, $22.6 million. So now I know what you're thinking. You're thinking, wait a minute, what was that revenue figure? Well, that revenue figure was about $21.7 million and the services was about 22.6. So yes, there was a negative net operating margin for the last year. And so as a nonprofit organization, we basically strive to kind of get to a positive net operating margin in some years, negative in others. We're trying to break even over time, obviously. And we have other sources of revenue that we can use to subsidize some of these operations as well, which Royal Oaks has typically done in its history. So we have our net operating margins, which is, negative $900,000. Now we do have to pay the interest on our long-term debt. So that's about 1.2 million. So now we have an outgoing cash flow of about 2 million. So what other sources of revenue do we have? Well, we do have a sizable operating reserve portfolio. And so we do use that, the earnings on there, to subsidize a portion of our operations when necessary. And so we've got that negative 2.1 million. Interest and dividends alone on our portfolio was about 1.4 million, just under 1.5 million. Then we have realized gains. So the realized gains are basically when you sell a particular equity and you have a capital gain on that, you basically capture that. So that's 3.4 million alone in captured gains or interest and dividends that we're able to use to help subsidize the operations. Now we do have to pay some investment expenses, about 241,000, which isn't too bad for those of you that want to calculate it. It's about 40 basis points, which is 0.40% on a $60 million portfolio. So that's pretty good on investment expenses. We do have a release from the development fund. So the development fund, that wasn't mentioned in the organizations because it's not an organization of itself. It's kind of a fund within Royal Oaks / the foundation. What the development fund is it's a fund that can be used for capital improvements of the campus. And whenever there's eligible capital improvements, Royal Oaks will make that purchase, and then the development fund will transfer money to kind of cover that purchase. So there was a cash inflow in for about $719,000 to cover those particular eligible capital purchases. And then there was a transfer to Cactus Sky for $500,000 last year. So when you net all of these things together, it comes to about $1.3 million. So you can see we flipped it from a -2 to a positive 1.4 million. Now, there is a few more things that are in the financials because they are in the accrual basis of accounting and they're not really on the cash basis. And so you have some of these other items, earned entrance fees, unrealized gain or loss, and depreciation. Those three items are non-cash. They are revenue and expenses because they do represent changes in assets or liabilities on the balance sheet. But the earned entrance fees of 7.2 million, that's not the entrance fees we received during the year. Remember, when we receive an entrance fee, we put it on the balance sheet and then we recognize a portion of every resident's entrance fee over time. And so that's the amortization that you see there. The unrealized gain or loss, that's from investments. So our investments are, as I said, mostly in equities, about 80%. So they'll increase and decrease with the market. And so, if we buy and we hold something, but we haven't sold it, if we bought something for $3 million and at the end of the year it's worth $2 million, we have an unrealized loss of $1 million. And so that's what that is no gain or loss would be recognized until we actually sell that particular equity. Depreciation, again, we talked about that with the fixed assets. We buy the property and or equipment, put it on as an asset, recognize a portion of that over time. And this is the portion that goes in that particular fiscal year, which is about 5 million. Then we do have marketing for expansion. So this is Carrie and Chuck and Greg and this beautiful building that we're in. All of that stuff we do have as in its own category that we have marketing for expansion. The reason for that is because the operations of Royal Oaks is to provide life care. So yes, we are marketing for expansion, but remember that's ancillary. That's not the primary purpose. The primary purpose is to provide life care. Once Inspirada Point is built and you move in and we're providing services, now all of that revenue and all of that expense is now part of the life care operations. It will shift to that particular section. So, So overall, when we net all this together, we're looking at a net income or loss for the year of about 1.4 million. And like I said, Royal Oaks is a nonprofit tax exempt organization, so you're not going to see any provision on here for federal or state tax. And like sometimes we're going to be on the plus side of the net income. Sometimes we're going to be on the loss side of the net income. Overall, we've had more gains than losses, which is why we have a positive net equity of $45 million. And that still is the strategy going forward. But like I said, sometimes we will spend a little bit, like we're going to spend a little bit so that we can build Inspirata Point. And then, we'll build back up that equity later as we're operating it. So we do have debt covenants that are attached to the bonds. So debt covenants are basically things that you tell the bondholders that you say, look, as we know that we're obligated to pay back the debt, but in order to help the bondholders make sure that we pay back the debt, they basically say, you know what, you need to run an analysis every so often to measure key metrics, because these will tell us if you're going to start running into a problem paying us back. And basically the two covenants that are tied to the bond are what they call a days cash on hand, and a debt service coverage ratio. So the days cash on hand is a calculation whereby you take your cash and you divide it by your daily operating expenses. So you figure out what your operating expenses are for the year, you kind of divide that by 365, you get a daily amount. Then you take that daily amount, you divide that into your total cash, and it basically says, this is how long I could operate if we had no revenue coming in, which we're not going to do that. We're going to have revenue coming in. So it is a little bit of a theoretical number, but that's what that number will tell us. The debt service coverage ratio is if you take the annual amount that you have to pay us, both principal and interest, and you take the amount that you have to pay us every year, how many debt payments could you make in a year? And we want you to be able to make 1.2 of those. Well, we've been able to meet our debt covenant ratios with 900 days cash on hand. So, just short of 3 years, and 4.4 debt service coverage ratio. Now, going forward, are these debt covenants going to come down? The covenants themselves will not. Our measurement probably will. So our days cash on hand probably will come down, and it will fluctuate, especially during construction, because we're going to be spending some money to be building a building, actually several buildings, and people won't be able to move in right away. They'll have to move in over time. Same thing with the debt service coverage ratio. We did take 20 garden homes offline, and we're going into a construction phase. So that debt coverage ratio will probably come down as well. Are they projected to come down to violate covenants? No, they are not. So let's talk about the expansion, because I've mentioned it a couple of times. And let's talk about how this is going to be structured. Well, we've already started the financing process. We're actually coming to the close of it, hopefully really, really soon here. Excuse me. And the financing is basically, we're going to have to borrow money to build this. I mean, we do have a lot of cash reserves, but we're not going to be able to spend all of that to build what we need. And in fact, with the capital markets being the way that they are, it does make sense for us to borrow nearly all of this rather than pull money out of an operating reserve that can average anywhere from 5 to 7% annualized per year. So we are looking to borrow to build the Inspirata Point project. Now, we're estimated to close this month in December. In fact, I'm looking at trying to close this tomorrow, in which case, once it closes, the bonds will be sold and the funds will then be deposited into, with the master trustee, into the various accounts that are set up in accordance with the bond. So what does that look like? Well, it's an estimated financing of 136 million. Now, that doesn't mean the buildings cost 136 million. It just means the project costs about 136 million, because certainly the biggest chunk of it will be constructing the buildings, but there's also, the design of the buildings, the permits related to the buildings. Then there's also some of the marketing costs. We talked about that so that we can market the building. And then we also have fill up expenses, because when we open buildings, we are going to have some startup expenses, some startup losses, if you will. And even though we've borrowed money, we actually have to borrow a little bit extra money so we can fund the interest on the bonds during construction. So with all of that, what does it look like? It's broken into two pieces, which is about $90 million of tax exempt permanent debt and $46 million of tax exempt temporary bank debt. And the difference between the two is basically how fast they get paid off. So the 90 million for the most part is going to be out there for about 30 to 35 years. That's why it's called basically permanent debt, not permanent as in forever, but certainly a long term. 46 million, the temporary debt, that is basically going to kind of be paid off first. So as people start moving into Inspirada Point and paying their entrance fees, the entrance fees will be used to pay down that $46 million of tax exempt bank debt. So that's basically why that one is called temporary, because it'll be paid off relatively quickly once construction is completed. So estimated construction timeline. So I'm going to go through the estimated construction timeline. For right now, keep in mind that this is an estimate and it is subject to change, but this is what we've got from the contractor as far as how long it will take and when certain things will start to become available, as far as they will call it substantial completion. In other words, we'll go to the county and apply for a certificate of occupancy, and we should be able to pass that inspection so they can give us that occupancy, so we can start moving in and getting it ready. Okay, so the first thing is if we close tomorrow, which again we're on track to do that, as soon as we close and we get the funds, then I give the go to the contractor and they basically start moving. Now, even though I will give them the official start in December, most of their work in December is going to be mobilization. So if you went out there and said, hey, there's nothing out there moving in the dirt lot, well, that's probably true, because they still have to mobilize. You know, the mobilization does include some administrative tasks like, you know, executing subcontracts, but it also does include ordering any various equipment to be delivered out there. So you might see equipment starting to be delivered out there, but it's not moving yet. And so you'll start to see probably a lot of mobilization in December, with more work actually starting in January. So the villas are going to be the first that will be completed. They're slated to be completed with certificate of occupancy in February of 2022. That means that's when we can get in there. That means that's, for those of you that may have villas, that may be the earliest that you can get in there as well. It's a little, like I said, you know, this is certainly subject to change, but for the most part, that is the schedule, the estimated schedule that we have for now. So the 3-story apartment building and the culinary building are scheduled to come online in November of 2022. So now, for those of you that are in the villas, you might be saying, well, where do we go as far as if we need a place to eat? We do have dining venues on our campus that you will be able to access, and it has plenty of capacity, and then the 3-story building will come on a few months later. Just due to the nature of how they had to schedule this, the culinary building had to coincide with the 3-story building. It was just the way that the contract schedule and the subcontract schedule worked out. And we're glad that it did, because we wanted it to come online as early as it possibly could. Lastly, the 4-story apartment building, because it's a little bigger, it's going to take a little bit more time. So that's scheduled to come online in March of 2023. Again, all of this is estimated, all of this is preliminary, all of that is subject to change. Lastly, I do want to touch on our foundation. So I mentioned that we have a foundation that we're kind of setting up for philanthropy, and it's a separate entity. Now, it's been around for a long time, and it's definitely raised quite a bit of money, and you'll be able to see that here. So we're really trying to develop it as a philanthropic organization, in that it's been raising money for the last 30 years, but we're really trying to more formalize it and maybe start to develop and define specific programs that the foundation will be able to talk to residents and donors about. And now, certainly those will change over time, but we're trying to develop that initial program right now. Now, that development fund I mentioned before, that development fund for capital improvements, Royal Oaks was kind of keeping that, but that was transferred over to the foundation at the end of last fiscal year, because as part of that philanthropic purpose, we want the foundation to hold any sort of contributions or restricted contributions. And so the board of trustees and the board of directors agreed that the development fund, those particular monies should be moved over to the foundation. So that was transferred and done at year end. The other thing that was done is we had an employee appreciation fund that was kind of resident run, and basically the residents on their own as a group would raise money, and they would distribute kind of a Christmas bonus, if you will, to the employees at the end of every year. In fact, the last distribution to the employees, I believe, was last week. And it's a very nice and very appreciative gesture. The employees love it. A lot of the residents love doing it. This was also another thing where the foundation went to that particular volunteer group and said, we really think you should come under the auspices of the foundation. And we researched it to make sure it was going to be okay with our CPAs, the ones that prepare our tax returns. And there are other CCRCs that have this as well, and they've incorporated it inside their foundation. And so, excuse me, we've been able to adopt that program into the foundation. So the foundation, as you can see, we had kind of a development fund over here. We had an employee appreciation fund run by residents over here. We had other fundraising things that the foundation was doing. It was kind of all separated like this. And we said, we really shouldn't be kind of competing against one another. We really should be cooperating, because all of this is for the benefit of the People of Faith Incorporated that does business as Royal Oaks. And really that should be the foundation. That's really what its purpose is. And so we really started to bring all of that to the foundation, and the foundation is now to start to put some programming and some wording around that. So when it can go and talk to residents about its programs and contribute and talk to its contributors about, if you contribute to this program, this is what it's going to do. And it's just that formalization is in its infancy, but I think it's really going to work out. So what does the foundation look like from a financial standpoint at the end of last year? And so this one we're going to break down into very, very high level. Its total assets was 24.2 million. Now, the majority of those assets are just investments. It doesn't have other assets like property and equipment, prepaid items, inventory. It doesn't have any of that. It basically just has cash and investments. That's the only, it doesn't have any receivables. So that 24.2 million, that is pretty much just cash and investments. It does have liabilities though. It has about $2 million of liability, but the vast, vast majority of that is what are its gift annuity liabilities. So the foundation does offer charitable gift annuity contracts, whereby for those that are interested, they can basically enter into a contract with the foundation to provide a charitable gift, and the foundation will then pay them a quarterly interest rate on that gift back to them for the rest of their life. The benefit to the foundation is the portion that you buy into that gift annuity, a portion of that can be a charitable gift to the foundation. And then of course on the other side, the donor actually does receive interest, and the interest is based on the age of the beneficiaries. So the average interest rate on some of these gift annuities is about 8%. So that's a pretty good return right now that you can't really get anywhere else. Again, net assets, same concept, total assets minus total liabilities, $22.1 million. Now, I will say the foundation does have some restrictions, because when donors basically contribute, they can restrict that for certain programs. So within its net assets, it has two categories. It has with donor restrictions and without donor restrictions. So out of that $21 million, 4.7 million is restricted by donor restrictions. So the donor said, I want you to spend it on capital improvements, or I want you to spend it on capital improvements for the Friendship House, or I want you to spend it on whatever. And so the donor placed that particular restriction on that particular donation, and the foundation accepted it, which means you have to honor that restriction. And if you haven't been able to spend the money on that restriction, that's fine. You just have to show that as a restriction. The remainder are all just open donations. They were just donations to the foundation or investment earnings on that, because it also has an investment portfolio, which is also aggressive. Kind of the same mix, about 80% equity, 20% fixed income. So that's 17.4 million. A lot of that is unrestricted contributions from residents and donors, and then over time, the investment earnings on top of that. So with that, what I want to do is open it up for any additional questions. Those numbers are actually old numbers. When I was doing a presentation, I had a call-in line for questions, but in this particular instance, I don't need that. Chuck, I'm going to, I don't know if you have any questions that anybody may have chatted or is raising their hand, or if there's anybody in the conference room that has any particular questions that they'd like me to go over.
I don't have any right now. If somebody has a question, if you could hit the chat or the Q&A button at the bottom of the screen. For the people that are live in our Zoom room here at our information center, Carter will go in and talk to you afterwards.
Okay.
We have a little bit of trouble getting questions coming in from there, but I don't see anything coming in right now. I appreciate you doing this, Carter. This has been informative for me. I've learned a lot just in a little bit of time that you've spent with us.
Yeah, and I know the presentation probably only went about 45 minutes or so, and like I said, we probably scheduled an hour and whatnot, and the reason for that is because, like I said, if there's questions, please go ahead and ask. Like I said, what I'll probably do is I might just pop over there if you, oh wait, something might be coming up.
Yep. Came in, what are the areas the foundation donates to?
What are the areas the foundation donates to? So the program, some of the programs that the foundation does, well, it adopted the Employee Appreciation Fund. So that's one of the programs that we discussed. It also got the Development Fund, which is for capital improvements. So that's another one. Other programs that it does is it has a benevolency fund. And so for those of you that, if you read through the Life Care contract, it does indicate that if there's any resident that basically runs out of money through no fault of their own, Royal Oaks will not ask you to leave. And the foundation will actually provide a subsidy to those individuals to cover all or a portion of their monthly service fee. So it does have that benevolency as well. The other thing it does is it does provide a what are called health subsidies. So for those of you that contract with Royal Oaks, the foundation right now has a program. Granted, it's subject, the programs can change at any time because it's subject to the board of directors. But with the benevolency fund, even if the foundation didn't pay for that, Royal Oaks would pick up the tab. That would never change. I'm just saying, as far as the monies that shift, the monies that the foundation pays is still subject to the board of directors. But they also have a kind of a health stipend fund. And for those of you that get permanently transferred to, say, a higher level of care like assisted living, the foundation will take a look at chipping in, like, kind of a monthly subsidy to help with any increased costs associated with that. Because although your monthly service fee doesn't change, we know that other things may change, such as higher, more frequent trips to the doctor, maybe higher prescriptions. And so they talk about maybe a $70 or $80 stipend per month to those individuals in assisted living. So those are just an example of some of the programs. What amount paid out for the benevolency program is another question that seemed to come in. Basically right now, annually, that totals to about $100,000 to $110,000 per year. There's anywhere from 5 to 8 residents that are on that program. I can't get any more specific than that due to confidentiality reasons, but that's how much it pays out per year right now.
We also have one that came in is this presentation available for replay? And what about the slides? We did record the presentation. We will be putting it up on the YouTube channel shortly. We've got to do a little editing on it. Sometimes it takes us a little bit longer, but the presentation will be recorded and will be available soon.
Excellent. Thank you, sir.
Anything else from anybody? Any other questions? And again, you'll be going into our Zoom room live to answer questions there. I don't see anything else coming in right now. So I think with that, we'll go ahead and
well, yeah, and I agree, with if there's no other questions right now, I would say for those of you, if you think of a question later, definitely reach out to somebody at Inspirata Point. to answer that question, or they'll get the question to me and we'll get it turned around to you.
Absolutely. All right. Well, with that, we're going to go ahead and end the call. I appreciate it, Carter. Thank you so much. And then you're headed into our Zoom room live.
Correct.
All right. Thanks, everybody. Bye.